Happy Monday, traders. It's 8:01 a.m. Chicago time on Monday, the 25th of April, 2022. Thanks for joining me today on episode number 2219. Derivatives trading is not suitable for all investors. Past performance is not necessarily indicative of future results. This morning, I don't have the pre-market summary sheet to start with, but there are a few things I want to cover. Just got tied up this morning, so I couldn't put it together with the team here. Today we did have we have quite a busy week this week, actually, being as it is Monday. It's appropriate to cover that here. This morning we got the German IFO business climate for April came in at 91.8 versus 88.2 expected. Tomorrow, the U.S. gets durable goods orders expected at 1.1%. New home sales for March at 770,000 units. Wednesday, German GfK consumer confidence and the Bank of Japan interest rate decision. By the way, the Bank of Japan, we need to pay attention here. The yen of all of the currency pairs, and the yen is a major one. The yen is behaving very interestingly. It seems like the Bank of Japan is really controlling, pushing to control the yield curve there. Pay attention to that if you're looking at macro. German inflation on Thursday, GDP growth out of the U.S., and then on Friday, we get GDP growth out of France, Germany, the Eurozone, and then we get personal income and spending from the U.S., and then the Caixin manufacturing PMI out of China on Friday evening. Now, those are the big pieces in terms of scheduled news, but this week, actually, in earnings is quite insane. We have about a third of the S&P and some really big players coming in this week and reporting. So this is going to be very likely to be an earnings-driven trading market. Last week, if not sure if you were here or not, but last week, it became a high probability that the Fed would raise 75 basis points in May, in addition to another potential 75 basis points in June, or at least 50 basis points. Well priced in is 50 basis points June, 50 basis points in July, in addition to tapering. So, market getting rattled. The weak sectors. The weak players, the weak stocks are going to be consumer discretionaries. That includes companies like Apple and many, many others, Amazon and so on. And so those, this is where the smackdown happened here in between Thursday and Friday. Some real risk overhang coming into play. And as discussed on Friday morning, I talked about the strong potential of a 43.34 test and a likely run to 42.50, if you recall, on the S&P, and that's where we ended up. Here's the, I'm going to dive right into the technical side of things here today. Here's the overall play. Last week, remember, 43.34.50 and 42.50. The idea from Tuesday a week ago is that we would open, test up, break down, and get down into the 43.34.50, but instead we rallied, which was really tough to deal with. Last Tuesday was not a fun trading day. Not only did we not kind of follow through, which is okay. The market does what it does. My job is to read the market and trade the price action. But I flubbed up a trade at 44.05 last week, and which could have caught the rally on the breakout. I screwed that up, and And then again, I screwed up a 44.26. I remember those trades well on the breakout of this low volume node here, and messed that up as well. But then we ended up coming back. We ended up pushing to 45.09 and coming back. Last week, some of the notes, just to share with you, some of the notes I put into the Head Trader channel at Convergent Trading. If you're a member, you want to scroll back and take a look at these from yesterday afternoon. I talked about we had a weak structure that was left behind from 41.52 1/4 way back here. This is all considered weak structure. There is no balance here, and as we break into it, it is likely to continue to remain weak. Look at the point of control of this rally week from March. The point of control remained at the low end of the range at 41.63 1/4. You do not want to see that on a good rally. You want to see the point of control shifting up, telling us that price is being accepted on the way up. However, this, as I was looking at the homework yesterday, last week we covered in RTH, we covered 246.75, 246.75 points last week in the S&P 500, which is a very, very high range. And I put down that for context, the most common weekly range over the last 252 weeks goes way back. It's about 5 years. The weekly range is about 70 points going back 5 years historically. Again, past performance is not necessarily indicative of future results. The 1 sigma, or what's considered normal weekly range over the last 5 years, is 113 points. The 2 sigma is 239 points. 239 points is considered the edge of the 95.45% of the data set. And last week we had 246.75. Let's call it 247. So we were 8 points beyond the second sigma of that data set. So highly, highly unusual range for the week last week. Really a marker week, not as big as this crazy rally we had in March on poor structure. What we saw last week actually is okay structure. We've got some pretty good distributions in there, but the point of control remained up at the 44.60, and the 44.60 represents the balance. See, this 44.60 also represents the balance of this entire area, and last week's point of control is right on top of that. So the market accepted last week and traded the heck out of that 44.60's most traded price, yet the price action ran away. We knew it would run away because as soon as we cleared this low volume node around 43.75, we expected that it would run down the flagpole in this thin area, which I pointed out on Thursday maybe, that if it starts to clear this area, we're likely to fall through. And the target, if we do fall through, is that low volume node at 42.50. And we are trading at 42.44.75 right now. The overnight session went as far as 42.18. So the target there was achieved in the overnight session. We did push to 42.50, but overall, the weekly action last week is outstanding. So there's definitely a very deliberate push lower. I expect a lot of overhead on the way back. I expect that if we get into the 43.75, that or if we get above the 43 handle, then you have the 43.34, 50 or quarter, and 43.75 as key test areas, because that's the neckline before we start to get into balance in 44.60. So these are I'm sharing these because I'm diving right into these many different levels and a price map. But I'm diving into this because I want to make sure that if you're listening here, that you do have a good grasp on the price map, and that you are being very agnostic and very factual about what's going on. Versus, I do a lot of reading on the weekend. I scan a lot of Twitter accounts just to see what others are saying. Not that I follow what anybody else is saying. But there's so much of that nonsense where it's just like, oh, this is it, guys. This is the big one. It's going to crash. I don't know. Oh, a big recession coming, 100%. I'm in cash. I don't know. We don't know. The biggest overhang, believe it or not, that's sitting out there, the biggest macro overhang that's sitting out there is what? Well, let me see what you guys guess. We're going to take away interest rates, and we're going to take away the taper as answers. What is your answer for the current biggest overhang that really isn't being covered very much? What do you think that is? Underemployment, COVID, sentiment, energy, geopolitics, inflation, China shutdown. Jeff, my man. The port in Shanghai is probably one of the most important in the world, and it's shut down. So you think we have some supply problems. They're continuing to compound, but it's very, very quiet. The China shutdown that's going on, I don't know if you saw any of the content or the videos out of there. It's pretty bad. And it's actually part of what fed into Friday sell-off, and it's not any better. It's not getting any better. And so you have these two massive ports, the mother of all supply constraints, these two massive ports, the Shanghai, China port, and there's a massive backup of vessels and so on over there. The place is shut down. And then, of course, you have the Los Angeles port, the west coast of the U.S. port. That line from China going east across the Pacific into the U.S., into L.A., those ports are really, really key. If you recall, during the shutdown, the president sent like National Guard or troops or something to go help the ports open back up because the labor wasn't there. These are really important and historic moves that are going on there. So keep a keen eye out and keep a close ear on your news feed when it comes to China, the shutdown. This is likely to trickle in. You're likely to see it mentioned during the Apple conference, earnings conference. You'll hear more and more about it. So keep an ear out for that. It's not helping that Shanghai shut down, and this is likely to put more pressure on prices as less and less materials making it across. Anyway, this is very interesting that you don't hear very much about it, but I get it from sources here and there, and it's like, wow, it's strange that nobody's talking about that. But we're looking at the S&P. Each one of these boxes, by the way, is 1 week. And what's going on, excuse me 1 second. And what's going on in the box is each bar is a day's worth of trading in RTH only, in the Wall Street session only, the New York stock or the stock session only, which is from 9:30 Eastern to 4 p.m. Eastern. Each one of these bars represents a day's worth of trading. And you can see that last week there was a multi-distribution, but really it's initiative action. We're moving away from bounce. We're moving away from the balance starting way back in March, the middle of March for this region, since that low of 41.52. And we're moving away from balance that we put in last week. Both are initiatives. So to me, this is likely to continue lower. And with this low volume node here, the low volume zone for this rally that we saw on the way up, this crazy kind of poorly structured rally, we're likely to see ourselves get back below the 4,200 from here over this week. Again, this week, a tremendous number of earnings are coming out, and so it's likely to be a very busy week. Here's what we did on Friday. Friday, we opened out of range. We had an open auction out of range. We tested, we performed what is just an incredibly textbookish test of the prior session low, which was 43.80. We went to 43.80.50, a very thorough, clean test. We put in an IB high. We fell back out of the range. And as you can see here, I'm going to kill these frac. Yep. As you can see here, we drop. And then last week was all about selling. Friday was all about selling pullbacks. Mid VWAP setup, mid VWAP setup, mid VWAP setup. And as it creates separation, it becomes about looking for pullback areas to sell. And on the close, despite the fact that we were selling on the close, we saw a lot of lifting in Delta to close out the week. These are positions that are balancing into the close of the week, and we see the Delta kind of rising as price is falling. Lots of hedging there going on. Multi-distribution profile, basically a trend day that finished at the bottom, which we did the day before, and I quizzed you on Friday morning about what is likely to happen. And I'm going to ask you again, because this is the Socratic method. I'm going to ask you again, if the market trends down and and finishes at the low, especially with the point of control at the low, what do we expect? What do we expect coming into the session on the reopen? Now, if you didn't get this on Friday, and you were here on Friday for this exact same setup and the exact same quiz, and you get this wrong, I don't know what to tell you. But very, very obvious answer. Well, let me give you an applause here real quick. Boom, there you go. Congrats. It looks like almost all of you got it right. It's important to note these things, because as we come in with the point of control at the low, the auction is interrupted by the fact that the market closed. But the auction itself has to find that low. It has to find these buyers. Like, unless we get down far enough for buyers to see that these prices are bargains, which we haven't gotten to yet, and to start buying up so that we're buying up at the close, we're ripping right back up, especially if we're ripped back up through the mid into the close and we leave an excess low behind, in other words, a strong low, then it is likely to continue. Very high probability. I cited that on Friday, 87% or so historically. It'll take out the low, and lo and behold, here it is. We open back up, and boom, we immediately take out that low at 62 and a quarter from Friday afternoon, and we continue to test lower. If you're a Convergent member, please go to the Head Trader channel. I posted screenshots of the order flow from the morning, and this morning we've got to keep an eye. It's been really, there's been a buyer kicking in, or buyers kicking in between 42.20, 42.22, iceberg buyers there the last time we went down there, all the way back up to 42.40. There have been buyers down there. So even though we have a weak low right there, a test, this is the 42.1850, 42.1850. We came back, we put in a slightly higher low, but you can see there's multiple bottoms there. And these bars, these buying bars, were really short squeezes, but the overnight session, as you can tell, could not take out the full session mid. The full session mid is this blue line, Couldn't take out the full session mid. So even though it is kind of accumulating, looks like there's some buying going on the way down, it has not yet found enough buyers to cause a pop above the mid. So this is opening week, and what we have here is a B-shaped profile overnight. A B-shaped profile with the point of control at 42.35. The VWAP's coming into 42.35, and the mid is above us. The VWAP coming into 42.35, the overnight point of control is at 42.35. Again, another number 3, pop quiz number 3. What does that tell us? What does that tell us? We're opening out of range. We have VWAP and the overnight point of control converging. What is that saying? Right? Go ahead and answer. Even though we remain below the mid. This is really choppy, balancy, open. Be careful coming into the open as there's incentive. Clue number one, we're out of the prior day's range. So there's an imbalance. There's some stuff that happened overnight that caused the sell-off. Doesn't matter what it is. There's an imbalance. So come in knowing, hey, there's an imbalance here. Does that imbalance? So when we have an imbalance, will that imbalance be resolved at the open with responsive buying? In other words, wow, this thing, you come in, traders come in and they're like, wow, this thing's sold off. Let me just cover my short position and buy the market. And so we get this response to the imbalance. It's called responsive buying. We go back to the prior day's point of control. Or is it initiative, meaning we come in and we start initiating in the direction of that trend. We start pushing away, initiating a move, creating more imbalance away from the prior session, which means that we leave a gap open overnight and we start moving to the next key areas below, which are 4,200 and 4,180. You could see those here, 4,180, 4,200, the low volume nodes. So, but right now, the overnight session is saying, hey, we've moved far enough that we have both sides trading, and we've traded quite a bit in the overnight session, 307,000 contracts. So that's what I want to leave you with. I know I'm almost like teaching during the Trader Bite, but these are important moves that we're seeing here, and we see that higher lows. We really fought this low. It's a weak low, so if it does give in, that 42.1850, if it does give in, a lot of this volume is going to spill over and cause a pretty strong move to the downside. But because we're opening with VWAP and the overnight point of control converging, we have a likely two-way open, which means expect a choppy, whippy open. And it's best to just sit on your hands and let the market discover which direction it wants to go, then step in and trade your reference points, your reference areas. Here are my reference areas. These are the stock zones. The over-under line is Friday settlement. You know, if it gets above Friday settlement, then we are very likely to tag to get back to that 34 quarter, 34.50. This is the important level to bring the market back into balance. This is a composite point of control. It's a micro composite point of control. These are big areas. This 34.50 is very, very important. So if we get back above settlement and show positive on the day, then we are likely to squeeze back up to 34.50. If we are not able, if we make an attempt at pushing higher and we're just not able to do that, then it's likely to test the 00 and the 180 below, giving us a pretty decent overnight range from about 42.50 to about 41.80, giving us that 70 points, which is higher than the day's range statistically. I'll let you go trade. It's 8:26. I don't have any scenarios here, but take a look. Take a look at what's happening. Yes, I just noticed this. Thank you. I was replaying the market earlier. It's the market has already pushed to 42.54 and it's holding above VWAP. Thank you for pointing that out. Even more choppy scenario there with a potential for a push back up. So this, my charts will catch up. Thank you all who noticed. I appreciate that. Take care. Oh, don't forget, Wednesday, hey, before you leave, Wednesday at 12 o'clock, we'll have another Futures radio show sponsored by EdgeClear, giving away 5 Logitech 4K cameras, really great cameras. It's the camera that I'm using right here. Be sure to sign up. Go to edgeclear.com/deli. The entries are due by 11 a.m. Eastern U.S. time. You have to have your entry in. The topic is pit to screen. We'll have Pax. Many of you know him as Pax, Matt Kina, as well as Earl Counter, and of course Anthony Credelli, veterans of the floor. We'll be talking about making the transition to the screen. We'll be sharing stories. Catch it all at 12 p.m. on Wednesday. I'll talk to you then. Take care.